Good morning, everyone. Thank you for joining in a little early. I think we'll just give it maybe 5 minutes and we'll start at 10:05 sharp, just in case other people are joining in, because I do see a few people coming in right now. And we'll begin with our webinar shortly. Okay, I think we've got 15 people in the room, and I don't see more people coming in. So sorry to keep everyone waiting, and I think we can start right on time. So today, one of the things that we wanted to talk about, actually, thank you everyone for joining us on this bright Saturday to discuss a little bit about investing and how the market has actually changed in the last few months, and what we need to do to respond to the changes that have already occurred and what's coming our way as well. So the inspiration behind this webinar was we've been seeing announcements in the newspapers where banks have started slashing their savings bank rates. We've also noticed a change in the fixed deposit rate. So clearly there is a shift towards lower returns from safer investments. At the same time, what you're seeing in the market is that it is a riskier place to invest today than it was, say, 6 months back or 12 months back, right? There is less visibility as to where we go from here. There's a lot more uncertainty, whether you're talking from a trade policy perspective, from a geopolitics perspective, uh, or wherever you, whatever lens you're looking at the markets in today, there are a lot of risks that are there. So, keeping this in mind, we thought it made a lot of sense to have a conversation around what you can do when you're going to earn only less than 3% from your savings bank account, and how you can actually look at smarter saving solutions and what you can do in this context, or how you should set your expectations correctly. So, this is going to be the broad theme of what we discussed today. At the same time, if you have any questions, if there's anything that you want to discuss, please feel free to type it into the chat box or the Q&A tab, and we'll get to your questions towards the end of the webinar. All right. So digging into the topic, what is our agenda for the day? We are first going to look at why are interest rates trending low, what's happening, what are the drivers for this. Then we're going to move on to what happens to your returns as an investor when you have lower interest rates. Then we'll talk about how you can make smarter financial decisions in this market. And finally, we'll touch upon a few investment strategies that you can use. So first, let's try to break down where these expectations are coming from, why you're seeing lower interest rates, and what the commentary is from the RBI. So when we look at what the governor is saying, you see that we have actually had this mandate to keep inflation at 4% with a tolerance band at plus or minus 2%. So inflation numbers being between 2 and 6% are within the comfort zone of the RBI, but 2 and 6 are actually extremes, right? You want it to be closer to 4% on a medium term basis. So when we look at growth, I think India has been doing very well on that parameter. You had through 2023 and 2024, you had the entire narrative around the India growth story, how India is uniquely positioned in terms of a growth economy, not just for this decade, but for a long time to come, simply because of the way our demography is structured, the way that we have pushed certain policy initiatives, whether you're looking at Make in India or Make for the World, how we're moving towards manufacturing, and we're already doing well on the services side. Yeah, so all of these factors have actually contributed very well to the growth side of the equation, right? The biggest risk, if we look at, say, 15-year data in the Indian economy, was currency depreciation as well as inflation. So when we look at what the RBI has tried to do by bringing in an inflation mandate and bringing in a monetary policy committee to make sure that we are focusing on the inflation mandate, you see that actually we've made reasonable progress since this was introduced, right? And today, if we look at where our inflation numbers are, last year, towards the second half, you had a lot of food inflation, which really drove your overall CPI numbers up, but that has stabilized. And this is primarily because of a couple of things. You've had a very good harvest season. And the more important thing is the forward outlook for inflation also is muted, primarily because you're looking at a situation where you're having a normal monsoon prediction. And given all of this going into this year, you're not going to expect the kind of inflation that you had last year. At the same time, if you have a global growth slowdown, then demand for commodities, demand for oil, all of this could also be weaker, which would again support a lower inflation expectation going forward. So we have actually done reasonably well in terms of managing inflation, which is your goal of price stability, and also in sustaining growth. So given this, we were in a very neutral policy stance for a long time. But what has changed in 2025 is that the RBI as well as the IMF and few other key institutions have lowered their growth forecast simply because of the global level of uncertainty that is there on the policy making front, the geopolitical instability that could come in. So over the last few months, you've seen these growth cuts, right? So now we are in a more accommodative territory. And if we look at how this has gone, the RBI in April cut interest rates for the second time. So you went from 6.5% in February to 6.25% in that meeting. Then you went from 6.25% to 6% in the April meeting. In the April meeting, they also very clearly switched the stance from neutral to accommodative, meaning that when you're in the neutral zone, you can either move interest rates upwards or downwards, and you can respond to risks on the inflation as well as the growth side of the mandate. Here, when the RBI moves into an accommodative stance, they're essentially saying we're not worried about inflation anymore. We are actually very worried about growth. So your rate hikes are completely ruled out. You can continue to stay at the same interest rate level, or you may even trend lower. With the way the committee is structured and the kind of voting pattern that we've seen over a period of time, I think it's become clear that inflation has now no longer the priority, and growth is the number one priority that the RBI is focusing on. So similarly, if we look at what are the inflation expectations, right? Your inflation expectation in February was about 4.2% from the RBI, and now this has come down to 4%. Your growth expectation was at 6.7%, and that has come down to 6.5%. So the RBI is clearly changing tracks at this point and trying to combat a slowing economy. 6.5% is still not bad in terms of how global economies are expected to grow. But the Indian aspiration is to grow at a higher rate. And we are in that sweet spot in terms of policy where inflation is not constraining us in terms of being more accommodative on the policy stance and providing more support for economic growth. So this is a quick look at how you're arriving at that 6.5% for the whole year. You're expecting Q1, Q2 to be good, Q3 to also be decent, and you're expecting a very slow Q4. Similarly, if we look at inflation, you're expecting the first 3 quarters to actually give you below 4% inflation, and the last quarter to be slightly more inflation. So broadly, I think when you look at this, you see that your slower growth and your higher inflation may only come a year away from now, right, in the last quarter. So what is going on? Now we've talked about what the RBI has done, and the key thing as to how it's going to affect you is that first the RBI kind of reduces your repo rate, which is your overnight lending rate to banks. And then when you reduce the repo rate, cost of funding for banks comes down. So then bank account returns basically start taking a hit because the bank cannot afford to sort of pay a higher rate of return to the investor. Then, when you start, so the first thing to take a hit is going to be your savings bank account, and then you'll have the term deposits or your fixed deposits that also take a hit. And then your cost of borrowing falls. So this is all on the lending side, meaning if you're a saver, you're going to be affected first. And then if you're a borrower, you're going to get in some benefits. So this is actually an important time for borrowers to think about how they can repay their debt and take advantage of the lower interest rate scenario that is there before them. So when you're able to downsize on your debt, you might be able to improve your cash flows. You may become debt free also in this time, but it needs to be a planned strategy. You can also consider switching from, say, a floating rate loan into a fixed rate loan. But again, you need to weigh these costs and advantages before you take any decisions, right? So on a floating rate loan, you can prepay at any time. There's no penalty. When you're on a fixed rate loan, you have to incur any penalty for prepayments that you do. At the same time, you might end up with a lower interest outflow in a fixed rate loan, and there may be, of course, charges that are involved in transitioning from one type of loan to another. So for every borrower, this maths is important, especially if you're looking at becoming debt free in the next uh, 3 to 5 years. It makes sense to really do the math and figure out what you need to be doing at this point and be prepared for it, because transmission to lend to borrowers takes a longer time than it does for um, the savers. The savers get hit first. So now I think we need to rethink the way we look at risk, right? One thing is that in the past, we've always been very inflation focused and we think about our inflation adjusted returns, right? For this next 1 year or so, I think you don't have to think about your inflation adjusted return so much because as we've discussed, you're clearly seeing an inflation trajectory that's moving downwards and not upwards. And given that you're going to have lower costs, you're going to have lower interest rates, and that means you're also going to earn less from your asset classes. And in today's context, you are looking at all asset classes providing lesser returns. You've had a very strong equity market rally, so forward expectations have to be lowered a little bit. Markets are expensively valued in most pockets. There are some pockets which are not so expensive. But at the same time, if you're in a lower growth phase, you can't assign the same multiples and earnings potential to company, right? So keeping all of this in mind, maybe equity is going to be a slower growth asset class. Fixed income is also going to be a slower growth asset class. You've had a very decent rally in precious metals, and even though you have long-term potential, we need to understand that precious metals also don't move in a linear trajectory, right? There are ups and downs in that journey as well. So, investors who are prepared to earn less in this period will focus more on risk management and preparing for the next set of opportunities. So, that is where we need to bring in our focus. There is still a good amount of time for investors to participate in fixed income. Uh, yes, some returns have already been made, but I do think that it's a great asset class to manage your risk today. So here are some strategies to preserve returns, right? So we're going to talk about, I think, 5 strategies in total in terms of how we can preserve our returns in a better manner in this scenario. So the first is for a fixed income investor, you can increase something known as duration. Now, duration is a metric that is used in the context of bonds, and it essentially, or even in your mutual fund portfolios, or if you're looking at a PMS or an AIF, all of these products have a metric known as duration. So duration essentially allows us to measure the sensitivity of the bond's price to the changes in interest rates, right? So the higher the duration of a particular bond, the more sensitive it is to changes in interest rates. Now, when it comes to fixed income, your bonds essentially the price moves in the opposite direction of your interest rate. So if your interest rates go down, your prices go up. The basic idea here being that when interest rate goes down, um, the new bonds that are issued with the same nature, right? So same credit risk, same duration risk, same liquidity, everything is now at a lower interest rate. So people who are earning more in terms of interest income, those bonds become higher in demand, right? So the price of those bonds is going to go up, but the overall market cost of borrowing has actually come down. That's the basic logic. You want to earn the same return as somebody else, and this is the basic idea in as to why interest rates and bond prices move in opposite directions, right? So when we understand this, a person who's able to take duration risk at this point is actually going to get two sources of returns. One is, of course, the regular coupon or your interest payment that you're going to get. The second is the appreciation in the bond prices. So when you're increasing duration in a falling interest rate cycle, you're actually going to try to maintain your ability to sort of earn a certain level of returns. So, but one important thing to keep in mind is that this all works out uh, in one direction. But if you have high duration risk and the cycle turns, you actually start making losses. So your entry valuation matters a lot, and you need to pay attention to when you're participating and taking a duration call. You also need to see where transmission has actually already happened, right? So where is it that this 0.5% of rate cuts that has already occurred, where has that already been reflected in the prices? So you can go back and look at, say, bond yields from January to now and see where the bond yields are today and whether it makes sense that you can still make some returns in terms of the yield change, right? So duration is one way to enhance your returns today. The second way for you to do this is to take a little bit of risk and move outside of the transmission game, right? So usually the transmission that we talked about, so if you remember that Venn diagram that I showed you a few slides ago, where we talked about first the repo rate, then the bank rate, then the FDs, and then finally your loans, right? So transmissions occurs mainly in the safer securities in the fixed income market. So if you're looking at government bonds or high rated corporate bonds, there you're going to see that transmission happen very quickly. But if you move down the credit quality ladder, then the cost of borrowing is not so much influenced by the repo rate. The cost of borrowing is actually controlled more by the issuer, right? So, what is the strength of their balance sheet? How are they positioned in this cycle? Are they able to manage their debt properly? So, these are the factors that actually influence the cost of borrowing in the high yield segment. So, high yield, of course, means that you need to keep some level of risk management. There needs to be a strong focus on the kind of borrowers you're lending to, the industries that you're lending to, whether it makes sense to sort of look at these uh, securities in a way that can give you that return, right? So here, when you're looking at high yield, you don't want to take duration risk because you're already taking credit risk, and the investor really needs to weigh out and see which risk is more suitable for them at this point in time. Some people prefer the income solution. So when you're taking duration risk, you're not really going to get any income. There's not really going to be any fixed return that you can expect. There is a certain uncertainty that is there around what your return expectation can be, right? On the other hand, when you're taking high yield risk, you're not going to take any duration risk. You know that over a short period of time, you can generate certain cash flows. And this can be achieved through either looking at individual bonds or looking at a portfolio of bonds in terms of maybe like a AIF or a PMS or something which is higher risk in nature. Right? This brings us to our third strategy. So the third strategy is to essentially lock into your horizon. So as an investor today, if you've already seen the rates on your fixed deposits drop, then it's time for you to consider how you can retain your return expectation. So if you have a fixed investment horizon, it can be 15 months, 20 months, 3 years, and you want to lock in your return for this period because you know that maybe taking equity risk in this time frame does not make sense, then you should look at products that have a fixed horizon, right? This essentially means you can look at fixed deposits, whether those are bank FDs or corporate FDs, which give you a slightly better return. Then you can find the deposit that matches your investment horizon and work with that. You can otherwise look at bonds which have a residual maturity that are matching your investment horizon. Again, this essentially means that you're looking at a bond where you have a certain number of years, let's say that it's going to mature by 2028, then you know that you have a 3 year horizon and it aligns with your goal, which is in another 3 years. Again, here you need to do a lot more if you're moving outside of the fixed deposit space, where your return expectation could be around 7%, into the bond space where you can increase your return expectation to maybe 9 or 10%. You need to again be focused on how to manage this risk effectively and make sure that whatever credit risk you're taking is not too much, right? So the structure and the nature of your bond matters a lot. So we would ideally look at something that is secured, listed, which is backed by some assets or a guarantee, where the investor is protected as best as possible. Then we come to our asset, fourth investment strategy, which is to practice asset allocation, right? So those of us who have been looking at the markets, it's been very volatile. Uh, you've seen a drawdown period from September to February. You've had a difficult month in March, and then suddenly in April, you've been seeing FII flows reverse, and you've had the dollar index weaken. You've had tariffs which were rolled out being withdrawn again. And then again, you have arrived at a situation where uh, you need to look at how you can manage your asset allocation, right? So when you're looking at your portfolio as a holistic unit and you're looking at what you can do today, then you'll understand that in this situation, when you know that interest rates are going down, equity market volatility is going up, having the ability to transition laterally from one asset class to another asset class to move wherever the opportunity is actually makes a lot of sense. So that window to participate in duration is open right now. The window to participate in credit is open right now. There will still be a lot of time for you to participate in equities. So for an investor who's preparing to participate in equities, fixed income is a great space for you to park your money in for some time. So that lateral preparation, right? That we don't know whether that shift is going to happen in 1 month, 3 months, 6 months, 12 months, or 18 months. But knowing that you're in one asset class and you will step into another asset class, and having that flexibility to move between the two makes a lot of sense in today's context. In this market rally, the most important thing for investors to do is to look at their portfolios and restructure them, because the next set of winners are always going to be different, right? All the great investors talk about market cycles and how you move from one cycle, one phase of the cycle to another phase, and how in each phase the opportunities are actually different, right? So wherever you've seen excellent performance, it makes sense to book out those profits and move into the newer, greener pastures that are there ahead of you, right? If you don't know what those pastures are, and it is a difficult market to invest, there is so much uncertainty that you are in a slowing economy, you are in a market where valuations are already expensive, but the market has moved up even further. It uh, goes without saying that investing is not easy in today's context. And knowing that it's not easy means that it's okay to wait it out a little bit. It's okay to let the dust settle. It's okay to get some clarity before jumping back onto the bandwagon, right? So when you have this and you're able to practice asset allocation, you can look at fixed income either as a strategic asset class, a tactical call, or something where you're just going to wait for some time before you make your next big move. And the fifth point that I wanted to talk about was becoming debt free. We spoke briefly on this when we talked about transitions and how interest rate cuts are being transmitted into the economy through the banking channel. Now, when it comes to becoming debt free, this needs a level of planning and construction, right? So you need to look at how you want to become debt free. There are a couple of ways to do it. You can, of course, the two popular methods take analogies from weather. So you have the snowball method, where you take your smallest debt, you clear it, then you move to the next biggest loan that you have, and then you clear that. And that helps you build momentum. So the idea is to look at all of your loans, rank them from largest to smallest in terms of how much you have to pay out, and then knock one by one from the bottom up um, each of your loans away. So this helps you build momentum, it helps you build confidence, and it helps you clear out your cash flows one by one, right? Um, the second method that you can look at is the avalanche method, which is you look at the highest interest rate loan that you have. And so you rank your loans in terms of the interest rate from high to low, and you start knocking out the highest interest rate loan. The basic idea here is that when you get rid of your high interest rate loans, you end up saving a lot on interest costs, and that create some more liquidity and freedom and flexibility in your cash flows. And when you have this additional flexibility and freedom, you are, of course, able to create more wealth for yourself. So both of these methods work effectively, and it really depends on what you prioritize, right? So do you prioritize, say, peace of mind, which would mean that maybe the snowball method would work better for you, because broadly you're looking at being debt free or having fewer loans that keep you up at night. If you prefer the mathematical route where you're paying less interest, then it makes sense to look at the avalanche method. So the basic idea is that you have these two processes in front of you. At the same time, you're in a situation where interest rates are lower. So refinancing your loans, restructuring your portfolio, deciding where to pay off, right? So if you don't see investment opportunities today, you could always use this to bring down your leverage or your loans or your liability, right? This is the fifth strategy. And finally, we need to rethink risk in today's environment. So when we're looking at risk, there are a lot of risks in fixed income. We usually think that the only thing we have to bother about is how much return we're making. And that is where a lot of investors get uh, caught, because they end up on the wrong side of a bargain that they did not anticipate, right? So first you have things like default risk. the last cycle, uh, you had your IL&FS crisis. People did not expect such a big name to default, right? Especially given that it had a AAA rating, which is the best rating a corporate can get. At the same time, IL&FS was not the only AAA rated entity that defaulted. You had DHFL also default on their loans. You had certain cooperative banks close. And this is something that an investor needs to be cognizant of, right? You need to look beyond the labels and the packaging and the names. You need to look into the balance sheets. You need to look at where the risk is coming from and whether that risk is manageable or not. Then, in today's context, an investor really needs to think about reinvestment risk. So, what is reinvestment risk? Let's say you have a fixed deposit for 1 year, which you bought sometime in December 2024. By the time December 2025 rolls around, it's very likely that the 1 year fixed deposit rate is going to be lower, right? You've already seen your savings bank rate come down, you're seeing your FD rates come down. So the between a deposit made last year and this year, there is a difference in the returns. Reinvestment risk means that when your investment matures, are you going to be able to earn a lower rate or a higher rate, right? In today's context, any investments that are maturing in the near term are likely to fetch lower returns than they did a year ago. So when an investor starts thinking about reinvestment risk, they need to think with a longer horizon, right? So you can no longer just auto renew your FDs on a 1 year basis. You need to think about what is the best time frame which aligns with your goals and your return expectations in terms of investments. The other way you can manage reinvestment risk is to take duration risk, and you can do that through the mutual fund route. And with the duration, you get that extra mark to market return because of the changes in the bond prices in the same time frame. Then, of course, we need to think about credit risk, which is so default is when you don't get the money back. Credit is, of course, the level of risk that you're taking. So, there is a sweet spot if you're able to identify the right papers where maybe the rating is the same, but the risk reward is actually in your favor, which is why product selection at this point matters a lot. If you're able to get the right products, then you're able to get a risk reward that is favorable to you, and it's not something that you need to worry unduly about. One of the risks that often gets a lot of attention is inflation risk. But in today's context, given the inflation outlook that I shared with you, we don't really have as much inflation risk as we did some time back. And given that there is lower inflation risk at this point, then for an investor, it makes sense to look at managing the other risks that are before them. One important thing that you're looking at is liquidity risk. Now, liquidity matters a lot when you're goal focused, right? If we enter into a product without managing the liquidity needs, then you'll always find yourself caught in a tough situation. The most important thing for any investor is to align the product to their goal, right? Many times what happens is we invest in products based on whatever is available before us or whatever looks attractive, but we fail to map it to our needs and our goals. When we focus on what we need to achieve, then we're able to pick the right products and you're able to create the liquidity that you need. So for someone whose liquidity needs are higher, it always makes sense to go through the mutual fund route, even if your return expectations are going to be lower. For somebody who can tolerate some level of liquidity risk, then you can of course look at bonds, you can look at AIFs. You don't need to put yourself into a product that can be immediately liquidated. Then we'll talk about regulatory risk because this is something that in every cycle we've seen what's gone on here, right? So if we look at how the RBI was regulating the NBFC sector last year, they were being very proactive in managing the risks that were arising out of your uh, unsecured lending space. So a lot of the NBFCs had to curtail their activities. They had to respond to certain things that the RBI brought up. And this could have created some stress for investors who own those bonds. At the same time, regulatory risk can present in a different manner for an investor, right? So every year before the budget, there's always speculation as to what will happen, whether there'll be something for the investors, whether some tax benefit will get taken away. So this is also a form of regulatory risk. And over the last few years on the fixed income side, you have seen a decent level of changes on the tax front, which have impacted investor choices. So the shift has already occurred from, say, pure fixed income products to hybrid products that get hybrid taxation or even equity taxation. So for an investor in these kind of products, where you're looking at hybrid just to optimize your tax, you need to really see whether the return expectations are the same as before or not, right? There are factors that influence hybrid products, which are different from what influences a fixed income product. So thinking through all of those risks and seeing whether the tax trade-off is really worth it is important. Then, of course, we have interest rate risk, and this is what we were trying to explain in terms of how when you take a duration call, when interest rates are going down, the duration call will work out in favor of the investor. But when the cycle reverses, having a high duration product would actually put you in a higher risk position. The basic idea being that when your interest rate goes up, your bond prices are going to come down. So you can actually make losses in fixed income investments when this cycle turns, which is something that many investors are not mentally prepared for, right? If you're used to investing in FDs, there's no situation in which you make a loss. You only earn lower returns. Whereas when you're taking a duration call, there is that upside potential, but there is also a downside risk. This is not that linear growth story. And the last, and I think possibly the most important risk for all of us in the room today is measuring past performance. So often an investor makes choices based on which fund has performed the best in recent times. But given that the context, especially the interest rate cycle, is changing, what worked over the last 1, 3, 5 years is not going to work going forward. More importantly, the notion of fixed income being tax inefficient or in another context not giving you high returns also doesn't make a lot of sense, right? Today the focus for every investor needs to be on managing risk more effectively. It needs to be on keeping your re- uh, flexibility and ability to respond to new opportunities at a much higher level. So we need to look beyond performance, we need to look beyond return expectations, and we need to think in a broader manner that allows us to compound for a longer period of time. So, what are the kind of expectations we need to set today? The first is, let's mentally prepare for interest rates to be lower for longer. We are heading into a higher uncertainty environment, which essentially means that the RBI would be a lot more cautious in terms of how we are going to look at growth and manage that risk effectively. The second is, for every investor needs to start prioritizing safety over growth. So I talked about how we don't need to chase returns. We don't need to focus on that. We actually need to focus on protecting what we've made in the last cycle. What you can do is to seek growth from other assets. So fixed income is not really a space that is ever going to give you this 2x kind of return. It takes a long time to double your money if you're going to grow at 6.5 or 7%, right? But this is a asset that can give you that landing space and allow you to grow into other assets, right? Uh, of course, we've talked extensively about risk, and the most important thing is not all of these risks are the same, right? So in today's context, you don't have to worry about inflation risk. Certain investors may not have to worry about liquidity risk. Other investors might have to focus on uh, managing reinvestment risk or few other things, right? So not all risks are the same, and how you take risk actually matters. And lastly, like one point that I would like to leave everyone with is that you can't control tax. So whatever it is, instead of trying to optimize for tax, you optimize for your goals. If you need liquidity, then focus on that. If you need stability, then focus on that, right? So control what is important to you. Don't sweat it out too much in terms of regulations or policy changes, because that is very much outside our locus of control. With this, I want to talk a little bit about the work that we're doing at Finesse and Milestones to Wealth. Milestones to Wealth is a program that we run for investors. The basic idea is that we want to help small investors think big, and we want to hold and handhold you through this journey to 1 crore, right? So wherever you are today, we would like to help you work towards that target of 1 crore. We know that it's not something that you can achieve overnight. This is a program that will run across multiple years, no matter where you're starting from. And what we want to promise to the investor is that we will guide you through this journey. We will teach you how to think about markets and opportunities. We conduct webinars on a weekly basis, right? So every week we have multiple webinars running under the Milestones to Wealth program, and they are all free for you to attend. You don't have to pay for anything. There is no cost in this program as such. At the same time, markets have their ups and downs, and we would like to mentally prepare you for what is coming slightly ahead, and how you can adapt to the changing environments in the market. So this is where we're able to coach and mentor you through this process. And finally, this is a milestone based program. So if you're thinking of a big number like 1 crore, we need to break that down into smaller components. And when we're breaking it down into smaller components, it allows you to measure where you are and to actually get to your next milestone and set timelines to get to your 1 crore journey. So a little bit about what we do in Finesse. We publish a blog every month. So you can see our outlook for the month. We talk about where we expect interest rates to be, what kind of investment strategies might work in this environment, what's going on the fixed income space. We conduct monthly webinars like this. We help investors who are enrolled in M2W with product selection and portfolio construction, as well as investment reviews. So if you have a portfolio outside, you want to get it reviewed, you want to make sure that you're doing the right thing in this market, you want to work with a professional, then you can always reach out to us and we'll be happy to help you take this forward. So with that, I'll open up for Q&A. So feel free to type in any questions that you have in the chat box or in the Q&A segment, and I'll be happy to address whatever is coming in. Okay, I see some things in the Q&A, so let me just begin there. Okay. Can we expect the new bonds will get issued with very lesser rates, say 8 to 9%, if FD returns are going to be 5 to 6%? So what will happen is the bond market is slightly different from your fixed deposit market. So like I mentioned earlier, when you're looking at credit risk, right, the factors that drive those returns are not going to be the same as the reason why your FD returns are coming down, because of the source of risk, right? Let's think of it that way. A bank is a much safer borrower than a non-banking finance company, which is, let's say, your tier one NBFCs might be of a higher quality than your tier two NBFCs or a microfinance institution that's lending to small borrowers, right? So because the source of risk is different, the cost of borrowing can actually be different, which means that the same kind of transmission may not happen. Somebody who's borrowing at 9.5% may be able to bring their cost of borrowing down to 9.2% or 9% at best. Whereas your FD, which was giving you 7%, can come down to 5.5% also. So the level of transmission, right, will not be as high in the bond space as it will be in the FD space. I hope that answers that question. Okay. Should someone need to sell their existing bonds when interest rates are low so that bond prices will be higher than the face value, or just buy bonds for cash flows and hold till maturity? Now, again, this depends on what your goal is. this is a great time. If you're able to get the right price, then it makes sense to exit some bonds, because you will get that mark to market appreciation. So you get a capital gain that's triggered out of it. Especially if you own listed bonds and your holding period has been more than 1 year, then I think you pay only 12.5% on the capital gains. So you get it's a more tax efficient strategy, and you can of course move into a different set of asset classes that work out. So, but on the other hand, if you would prefer some stability, or if you are preferring some source of cash flow, then it makes sense to hold till maturity. The other reason that you might end up holding to maturity is because the bond market is structured in such a way that it's not very easy to buy and sell at a reasonable price, right? So that liquidity can take time to generate, and because each transaction is done through like a broker dealer and there aren't too many platforms where you can freely trade, I think there you will have this risk that is there, right? So in that scenario, if you don't get the right price, or if you want cash flow, it makes sense to hold till maturity. Okay. So when people ask about the NCD of any particular company, right, there are a few things that you need to look out for. Bonds are very different from stocks, right? So if you ask any analyst about a particular company on the equity side, they'll be able to tell you at a high level, okay, is it a good company? Is it expensive? You can easily sort of uh, give a high level opinion about these entities. When you come to bonds, each company can actually issue multiple bonds, and each bond can be different in nature, right? So, for example, uh, is this when you're talking about an NCD, especially from a bank or an NBFC, you need to understand, first of all, is it tier one or tier two capital, or is it a regular bond? If it is tier one or tier two capital, it is already much higher level of risk than a regular bond. The second thing that you want to look at is when the interest payment happens, right? So is this a regular interest payment? Is it something that comes only once a year? If it's a tier two bond, then sometimes there is no guarantee on interest payment, right? So the investor needs to understand whether that is a risk that you want to take, because the assumption has always been that if it's a bank bond, it will be safe, right? But you have seen that in Yes Bank as well as Lakshmi Vilas Bank, the tier two bonds got completely written off. The bond investors didn't get anything, but equity investors got something, right? So we need to understand what is the nature of the capital or the nature of the bond that is being issued. The third thing that you want to look at is whether it's listed or unlisted, because again, if you have a listed bond, then you can enter and exit, and you may have that potential for capital gains as well. uh, then you want to look at the credit rating and see how risky it is, and compare with bonds of a similar rating what is the interest or the yield that you're getting, right? uh, and then of course you want to look at things like guarantees. Is this guaranteed by somebody? Is there no corporate guarantee on this bond? So all of this would sort of determine your risk level. Now if I am getting a bond with all the risk characteristics, but it's giving me only 10.5%. Does it make sense for me to take that risk in a bond, right? If equity is able to give me a 10.5% return with the same level of risk, right? No cash flow guarantee, no capital protection, no uh, uh, none of the features of protection that fixed income offers, then I would think that it makes sense for you to avoid something like that. If it is, on the other hand, a secured listed bond, guaranteed, and you're making a decent return, then of course I think it does make sense to look at this. So on the fixed income side, you need to really study what is known as the term sheet and the document before you sign up for anything. So we still have about 10 minutes. So any questions that you have, if you want to talk about anything else, even if it's not on the fixed income side, we can chat about this. We can talk about the markets, anything that's worrying you. If you want to know more about milestones to wealth, or if you'd like to enroll, then I'm happy to talk to you about our work on that side. If you have questions that you're not comfortable asking in this audience, then please feel free to drop us a message on WhatsApp at 9677000613. We will respond to your questions. We basically do, we have a number where you can ask M2W anything. And the idea is that we will respond to you directly on a one-to-one basis. And you don't need to interact in a public space. You don't need to uh, feel shy about asking anything. The idea is to help investors grow from wherever they are. Sorry, sir, I don't fully understand your question. Can I invest and hold the fixed component till retirement? You are 38 now. I mean, that's a long horizon. You're talking at least 15, 20 years, right? So we need to think about whether it makes sense to hold any investment for that horizon. You can buy, I think, if you're looking at certain mutual fund products, because the fund manager can dynamically adjust the risk, it makes sense to hold things like that. Uh, you can also look at a multi-asset product. So we have a PMS, or if you join M2W, then the overall approach is multi-asset oriented, but it's not really buy and hold. You do have to move across assets. Yeah, I think in our experience with the investors that we've been working with on milestones to wealth as well as ithought MFT, there has been a reasonable openness to participate in assets outside of equities. You are right, of course, there is, I think, general in the DIY community, maybe there is not so much uh, interest in assets outside of equities. But that is a choice, right? I think those investors have a very different risk uh, and return expectation profile. But I think on the guided investor side, people are cautious of equities. I think that depends on who we are talking to. I feel we have been working with uh, thousands of investors. They seem quite comfortable doing multi-asset, looking outside of uh, equities. And we have been quite vocal about talking about fixed income. We are not seeing resistance there. So I do think it depends on which audiences you're interacting with. No, even young investors, I think we are seeing on our side, because Milestones to Wealth is broadly a program for smaller investors, right? And we run programs for Gen Z as well as uh, people who are starting out work, and women investors. So I think across the board is our experience. Is there any debt investment which gives steady 8% rate? So I think if you're looking beyond 7%, it has to come from uh, the bond side, right? It will not come on your fixed deposit or your mutual fund side, especially in today's interest rate scenario. Uh, you can do SIP in debt, but you should lower the return expectation anywhere between 6.5 to 7%. If you keep that as the return expectation, there are definitely some very good products where you can do your SIP also on the fixed income side. Would you please speak about bond laddering for fixed cash flow? What is the role of interest rate cycles with it? So the basic idea for laddering is that you have bonds that mature in different years so that you get a bulk payment out, right? So for somebody who's retired, you will have, say, one bond maturing in 2026, 2027, 2028. So every year there is a bulk payment that comes out. The basic idea is that um, you create a set of cash flows that match your retirement expenses. This is common in the US. It's not very common here. Uh, and I think you need to look at a retirement corpus from a more holistic angle in terms of having some assets that generate cash flows and having some assets that help you beat inflation, because that's a bigger risk here, right? In the US, your inflation risk has been around 2% until recently. So it made sense to have a laddering kind of thing where just the maturities would take care of your cash flow requirements. But in a context where both inflation and cash flows need to be managed, uh, an investor needs to look at asset allocation as a solution. What about pension or annuity plans with deferred lock-in at higher rates for future when rates drop or fall? Still, the agreed higher ROI will be paid, right? It's more guaranteed with no interest rate risk, but more assured. Then why not? Why only mutual funds or bonds? Because taxation are all are same only anyway. So I think the reason why we don't advocate pension or annuity plans is that you lose control of the entire capital, right? So you might get like a 7.5% return, but you will not have access to those funds at all. If you choose to have a return of purchase price or premium option on these products, then the income that you earn will actually be lower. So there is that trade-off between controlling what you own and having access to your assets versus the income that you earn from those assets. This is the reason why we would not advocate pension plans. And when we work with retirees, I mean, of course, if you have a pension component, right? Let's say you're an NPS investor, you have a pension that comes in through that, that is okay. Or if you're a government employee and you have a pension component to your retirement corpus, that's fine. Some part of it, of course, if you want that stability in terms of cash flow, makes sense. But a bulk of it, I would not recommend, because that means a majority of your assets are locked into a product that you cannot liquidate at any point. Whereas when you're looking at mutual funds or bonds, at least you can buy and sell these assets and you can create that liquidity whenever you need it. And for a retired person, that is actually very important to have that liquidity, because you can have a sudden medical expense, you can have goals that change, right? So after you retire, maybe 10 years down the line, your children will have children, you might want to do something for them. So we have seen uh, goals change post retirement. And that liquidity and access of capital is it's a very practical advantage for a retired person to have. Do you consider PPFA's dynamic asset allocation fund as a debt fund allocation? No, because that is a multi-asset fund. Debt is proper debt. It's not hybrid. But if you have a hybrid or a multi-asset fund in your portfolio, that's a good way of managing risk. We prefer to do individual funds uh, and control the asset allocation at that level, because if we look at the way SEBI has categorized funds, right? The basic thing when it comes to a multi-asset or a dynamic asset allocation or the hybrid funds is they only define the weights in the asset classes. So they may say you have to have minimum 65% in equity or minimum 10% in debt or something of that nature, right? But there is no control on where that equity or where that fixed income allocation goes or what the quality of those underlying assets are going to be. So someone in a hybrid product may think because it's labeled as a conservative hybrid fund that it is a conservative fund. But what if the fund manager is actually buying very risky debt and equity, just meeting that asset allocation level? And we have seen this in the hybrid category products as well, which is one of the reasons we prefer to control the quality and the kind of um, products that are there in the fixed income side. All right. So I would just like to thank everyone for coming in and participating um, in today's session. A lot of very interesting questions um, that have come in, and it would be our pleasure to talk to you again at one of our other webinars soon. And thank you, everyone, once again. Thank you, sir. Have a nice day. So I'll be closing the webinar.